there's sort of a meshing of multi-narratives here, Greg, which I know probably bothers you as much as anybody. But I think what Kayla just said is really important, that until there's some movement on the FDIC front to clarify what the rules are, we're probably going to see the market kind of push this to a crisis point again.
Yeah, I think there's a couple of things going on, Kelly. There's the policy aspect, and then there's, I think, the technology structural aspect. On the policy aspect, I think the Fed and the FDIC have definitely bought time. So long as there's this assumption that they'll declare systemic risk exception and save any bank's uninsured depositors, then I think that sort of like stabilizes things for the mid-sized and smaller banks. But I think hanging over that, Kelly, are just these longer-term structural factors that are just going to corrode their competitiveness over time. First of all, we know that Silicon Valley Bank was not the only bank that had a lot of unrealized losses on its bond portfolio. There are a lot of banks in that situation. As my colleague Jonathan Weil reported this week, a lot of banks have been, shifting bonds from their available for sale to their hold to maturity category, specifically to avoid recognizing that. We also know that there's a surge in deposits over the last couple of years, most of them uninsured. And that what we saw with Silicon Valley Bank is that the easy availability of moving your money around with like a smartphone app means that those deposits are just a lot less stable in the past. If the Fed is going to keep rates high as for a while yet, as Steve just told us seems likely, that's going to put a lot of pressure on these banks to start raising deposit rates. That squeezes their funding costs and creates long-term pressures.
You know what's ironic, Greg, is rate cuts would actually probably do a lot to stanch this from getting worse. If they normalize, harmonize to some extent. I mean, Joe Abate at Barclays thinks another $1 trillion could move into money funds, and imagine what that's going to mean for regional banks. Like you said, this is going to be a solvency, maybe not solvency, but a profitability issue for quite some time.
I mean, if you look at the decline in these stocks prices, Kelly, that's exactly what the market is telling us. The common equity is really telling us this is what we think the future value of their lending franchises are. We don't think they're worth very much in a world where your funding costs are going up a lot. And by the way, if the federal government does extend these tougher capital liquidity ratios to the mid-sized banks, that too starts to squeeze them. It raises their cost of capital. It probably reduces the return on their assets. And that too, I think, represents an existential risk. And then if at some point the assumption of deposit protection is weakened, then what do you think is going to happen? Bankers, smaller bankers and savers are going to say, well, listen, if I need to move my money somewhere, I might as well move it to the banks that the government has already indicated through its actions it will not allow to fail. And I think that's just together a very tough set of circumstances for the smaller and mid-sized banks to navigate in the coming decade.
Absolutely. Greg, thanks for joining us today. It's well said. Encourage everyone to read the piece. Good to see you again.